Hi guys, it's Stock Curry, and now that the bank fears have started to subside, you probably want to know, when will the stock market recover? Well, we finally have some good data that will give us a good indication on when the stock market will recover, so let's get into it. We've now made it through our second week in a row without a bank collapse, and this has caused a lot of the banking fears to start to subside. The deposit drain from smaller banks into financial giants like JP Morgan Chase has slowed down. The deposit drain began improving around March 16th. Now, this is a really good sign for banks and will really help shore up confidence in US banks, but it is important to understand that the situation is still fluid and could change if concerns about other banks arise. The fact is, the past few weeks have exposed a glaring weakness in how some banks have managed their balance sheets, which could lead to more turbulence. But at least for now, bank deposits have stopped moving from regional banks into the larger banks because the people who panicked got out right away. If you haven't made up your mind by now, you're probably going to stay where you are at your smaller regional bank. You should also remember that it's going to take time for things to get better. While inflows at one top institution have slowed to a trickle, at another large lender, inflows only slowed in recent days. And people are still fearful about who might be the next bank to fall. For now, attention has turned to First Republic, which has teetered in recent weeks, and whose shares have lost more than 90% in the last 2 weeks. Regulators and banks have already put together a remarkable series of measures to try to save the bank, and regulators believe that the deposit situation at First Republic has stabilized. But if those measures to shore up the bank fail, there is the risk that regulators would have to seize First Republic Bank, similar to what happened at SVB and Signature Bank. And while fears have subsided for now, it's likely that other institutions will face upheaval in the coming weeks. And it's not just the issue at the regional banks that we have to be worried about. The fact of the matter is, this is already causing problems worldwide, as we saw with the collapse of Credit Suisse. The fact is, US bank failures pose a risk to global growth. Although economists broadly believe that a full-blown financial crisis is not likely, they also see heightened risks to global growth from this shaken banking sector and the possibility of tighter credit. If you look at the National Financial Conditions Index, which is the Fed's preferred measure to see how much financial conditions are either tight or loose, while they did become extremely loose going into February, they've now tightened significantly. The immediate risk is that banks in the US will keep a tighter leash on lending. And Powell said on Wednesday that such a scenario is potentially quite real and could easily have a significant macroeconomic effect. A U.S. lending squeeze could have an effect on global growth by pinching demand for other countries' goods and services. As lending gets tighter here in the United States, it makes buying expensive imports even more expensive, especially when it comes to things that people finance like automobiles. More broadly, global trade and the financial system are underpinned by the US dollar. That means tighter US financial conditions, such as less lending, higher borrowing costs, lower prices for stocks and other assets, can quickly spread to other economies. So even though we're not in a full-fledged financial crisis like we were in 2008, the fear is that a slowdown in US lending could still cause a global recession. And the financial risks are broad. So let's take a look at where all of the financial risks lie. As the federal funds rate has increased significantly over the past year, this has caused major losses for banks. And it wasn't just Silicon Valley Bank that had major losses in their mortgage-backed securities and treasuries. The fact is that all banks have major losses in their mortgage-backed securities and treasuries. to the tune of more than $500 billion in losses. Now, those losses aren't a problem so long as those treasuries and mortgage-backed securities are held to their expiration. However, when people start pulling money out of banks and they go on a bank run, then the banks are forced to sell these and turn those unrealized losses into realized losses. And when unrealized losses become realized losses, that is when we have major problems at the banks and we get these bank collapses. And it's not just a run on the banks that could cause unrealized losses to turn into realized losses. There are other problems on the horizon as well. Another risk is the commercial real estate sector. As the U.S. office vacancy rate has skyrocketed in the past 2 years, this has caused the value of commercial real estate to drop significantly. In 2008, when home prices dropped significantly, this caused a lot of homeowners to become underwater, or in other words, to owe more on their mortgage than their house was actually worth. And when that happened, the homeowners simply stopped paying their mortgage, and the banks had to take on all these houses at major losses and then try to sell them at major losses. And while we don't have that same problem in the US housing market yet, even though we did have the first official decline in home prices in more than 11 years, the more immediate concern is the commercial real estate market, where many office spaces are now valued far less than the value of the actual mortgage. And this has caused banks to take on massive unrealized losses on these commercial and other industrial loans and real estate loans. Banks have an estimated $2.2 trillion in losses on commercial loans. That includes $620 billion in reported unrealized losses and $1.7 trillion in an estimated unrealized losses. Those unrealized losses could become realized losses if the owners of this commercial real estate stop paying on their mortgages. So you can see how the losses from the mortgage-backed securities and the treasuries that everybody's been focused on that has caused these banks to collapse over the past few weeks, those losses only total $580 billion across all banks. But the commercial real estate losses total $2.2 trillion across all banks. The commercial real estate losses are 4 times larger than the mortgage-backed security and treasury losses that caused 2 of the largest bank collapses in U.S. history over the past 2 weeks. So you see, banks are not out of the woods yet. There could be many more bank collapses over the next few months. Possibly, estimates are as high as 200 bank collapses over the next 6 months. And yet, while this is the worst banking mess since 2008, it's not freaking out stock market investors. Well, at least not yet. And there's 2 reasons for that. First, investors are broadly assuming that regulators are going to step in and reinforce the sector if need be, and that's what's keeping it from spilling over into the broader market. Second, investors see the banking woes forcing the Fed to pause the rate hike cycle or even begin cutting rates as early as June. And this is what is really perplexing, at least to me, is that for the past 2 Fed meetings, Jerome Powell came out and very clearly stated that the Fed will not cut rates in 2023. He very clearly stated it at the last Fed meeting on Wednesday. He said the market is getting it wrong. We will not cut rates in 2023. And do you know what the stock market did? Do you know what the futures did when Jerome Powell said that? They priced in more rate cuts. That's right. Jerome Powell came out, very clearly said there will not be any rate cuts this year, and the market turned around and priced in more rate cuts. Before the Fed meeting, the market was pricing in 3 rate cuts this year. Now it's pricing in 4 rate cuts this year. So either the market is completely delusional and is just going insane right now and eventually is going to wake up to reality and absolutely crash, or Jerome Powell and the Fed are dead wrong and the market is right and the Fed is going to be forced to reverse course and start cutting rates later this year. But it's important to understand that the bullishness in the market last week came amid volatile trading, meaning it's not sending an all-clear signal yet. The fact is, bank worries have not gone away. And those jitters were on display on Friday when shares of the German bank Deutsche Bank fell by over 8%. And if you look below the surface, the stock market appears to be bifurcated, meaning much of the resilience in the broader market is attributed to gains for mega cap technology stocks, which enjoyed a bit of a flight to safety roll over the past 2 weeks. The mega cap tech heavy NASDAQ was up 6% in March through Friday's close. Meanwhile, regional bank shares dragged down the small cap Russell 2000, which was down 8.5% over the same period. So we've got the NASDAQ up 6% while the Russell was down 8%. And I have never, ever seen the NASDAQ and Russell trade in such a widely polarized way where one went sky high and the other crashed down. It is unbelievable what's happening in the stock market right now. And it just goes to show that even though the stock market appears to be pretty bullish, the fact is that bullishness is limited to only a few stocks. This means that for you, the expectation should be for continued volatility because we have less money flowing through the economy. This means that with the Fed doing quantitative tightening, although that reversed a bit in the last 2 weeks, which is why we saw stocks and especially crypto go up, but as they resume their quantitative tightening, we should see especially crypto start to come back down. And this could also put more strain on the stock market. At the same time, with this huge uncertainty about the future of the economy this year, it's going to make volatility stay, which means a lot of massive ups and downs in the stock market. But if the bank issues that we see do appear to be resolved and the Fed has in fact paused, then we are likely to see a shift to a more risk-on environment. And that would favor equities, including cyclical and small cap stocks. But more likely, we're trapped in a narrow range for the S&P for a little while until either growth breaks to the downside or inflation breaks to the downside. If growth goes down, that could cause stocks to go down over fears of a recession. And if inflation goes down, that could cause stocks to go up over a belief that the Fed will pause and might even cut rates. And all of this hope about the Fed cutting rates has caused the fear and greed index to rise from 24, that extreme fear level that we saw last week, all the way up to 33 as of Friday's close. So while it's still fearful and still indicates some bearishness in the market, it is rising, which might be the sign of a rebound. But even though we're getting some bullishness back in the market and we have some signs of a possible rebound right now, Bank of America has identified the next bubble and says investors should sell stocks rather than buy them after the last rate hike. History, according to Bank of America, says to sell the last interest rate hike. The reason for this is because credit and stock markets are just too greedy for these rate cuts, And they're not fearful enough of the reason why the Fed would actually cut rates, which is a recession. After all, when banks borrow from the Fed in an emergency, they tighten lending standards, which in turn results in less lending. That leads to less small business optimism, and that eventually leads to a crack in the labor market, which leads to a recession. So right now, the stock market is bullish on hopes of the Fed pausing and then actually cutting rates this year, and just extreme bullishness on the hope of 4 rate cuts later this year. And the stock market is completely ignoring why the Fed would actually cut rates, which is we might be entering a pretty significant recession. Historically, when the Fed stops raising rates, the stock market continues to drop for another 6 months before it finally bottoms out, as we usually end up entering a recession after the Fed stops cutting rates. The fact is, the Federal Reserve is more likely to continue to raise rates rather than cut them, as inflation remains sticky. And now there are fears that there may be no return to normal for the U.S. used vehicle market. A notable decline in used vehicle prices towards the end of last year has been cut roughly in half in 2023, as inventories remain significantly down following vehicle production disruptions. And it looks like high used car prices will persist for some time. As you can see on the chart, even though used car prices started to decline last year from their peak at the end of 2021, they have now started to rise once again. Wholesale used vehicle prices are up 8.8% this year through mid-March, while used vehicle inventory is down 21% from a year ago. So what's the solution to high car prices? Well, there's no other course but an increase in new vehicles being produced. The problem, though, is that we're unlikely to go back to pre-pandemic new vehicle production levels. Automakers are not manufacturing as many as they have because they've got the taste of gold. Huge profits from not having so many new vehicles in manufacturing. So while the stock market remains a bit delusional, there are at least some reasons why the market might rebound right now, and there's a lot of reasons why the market might drop for another 6 months before it finally bottoms out. So we'll have to wait and see just exactly what the stock market does. But for now, let's get focused on what the stock market is going to do this week. Now, over the past 2 weeks, we've been in a very news-driven stock market, but this week we get a bit of a reprieve from all of the news. While we do have some Fed governors speaking this week, we only have one major economic news coming out this week. And that is the PCE index coming out on Friday, as well as personal spending. Now, the PCE is the Personal Consumption Expenditures Index, and this is the Federal Reserve's preferred measure of inflation. And the PCE is expected to have declined month over month and stayed steady year over year, following in the footsteps of the declines that we saw in CPI and PPI earlier in the month. So that's what's going on this week. It is expected to be another very volatile week with a lot of swings up and down, but mostly trade in a flat, narrow range, at least until Friday, when we get some data on inflation. And once that data on inflation comes in, then we might get a little bit of a breakout either to the upside or downside. Now, when I say a tight, narrow range, I'm not talking about 0.5% movements each day. I'm talking 2-3% movements that end up flattening themselves out after a few days. Again, very volatile week is expected this week. Now, there is way more news and information than I could possibly include in one video. So if you want to stay up to date on everything that you need to know for the markets before they open on Monday, I would suggest you go sign up for my free weekly newsletter. In that free weekly newsletter that goes out every Monday morning, I explain everything that you need to know to prepare for the week ahead, including an in-look into the technical analysis of the market and a deeper dive into the market sentiment, as well as a look at the earnings that are coming up that week. If you want to get a hold of that free weekly newsletter, all you got to do is sign up at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you got a lot out of this video, then be a good friend and share this video on your social media pages so that everybody you know will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you missed last week's video where I went into a little bit more information on what's going on, make sure you watch the last video I uploaded here.